Hello, I'm Troy Harmon. I'm here with Nick Antonucci. This is your market update from Henssler Financial for January 2018. So Nick, January, let's look back a little bit further than we normally do into 2017. The equity markets were awesome last year, almost 22% return on the S&P 500, 21.82 to be exact.
Absolutely, and the mid and small cap stocks did pretty well. Also, rising 16%, 13%. They underperformed, which typically they outperform large cap stocks. Nonetheless, they're up 16% and 13% respectively. So overall, it was a great year for equity markets. Hopefully, you're invested and saw your portfolio increase in value this year. Only two sectors.
Technology. Let's say
the big winner.
38.83%, almost 39%. But earnings grew like crazy in that space, so
justifiable to some extent.
To some extent, right? And they were playing catch up because they didn't really move back on the election of 2016, which they did catch up with financials that are up about the same percentage from November 7th of 2016.
Prior
kind
to
of an interesting thing.
Yeah, and only two sectors were negative for the year. That was the energy and telecom sectors. Not a huge shock there, and nonetheless, they were barely negative by about 1%.
Right. One thing you need to keep in mind, our average return on the S&P 500 on an annual basis is about 10.5%, so we basically doubled that in 2017.
Right, and for that to average out, we got to have some years below that 10%.
We don't have to, but it always works out that way.
It does.
All right, let's move on. We've got a lot of information in the economy. Let's start with housing prices.
Yeah, housing market in December continues to look strong. Actually, most of these are looking back to November, if not earlier. The latest Case-Shiller Home Price Index saw prices rise 6.2%. Good news there. Existing home prices, existing home sales rather, new home sales both increasing. And you're starting to see that pipeline fill up a little bit as well because housing starts also ticked up in the most recent reading.
Right,
so all in all, your home value continues to increase. We still encourage, to buy a home if you haven't yet. Rates are still low. Now there's some other things that will come into play we'll talk about later with the tax changes.
Right, refinance if you haven't already, but boy, if you haven't, you're way late.
You are.
All right, let's talk about third quarter GDP. We did have growth of 3.2%, which is a tick lower than we had seen previously reported at 3.3%.
Right.
We're also looking into fourth quarter, which we should get details on this month.
Estimates are for between 3% and 4%.
That's
kind of a wide range. If you look at the different Federal Reserve banks, some are forecasting around 3, some around 4. Bottom line is if we can get growth in excess of 3%, this will mark the first time since 2005 for 3 consecutive quarters of 3% or better GDP growth.
Yeah, that's obviously good news, and our lowered regulations and taxes are playing into that, without a doubt. We also have information on inflation recently. Seems like CPI, Consumer Price Index, as well as the PCE deflator, the inflation marker used for the Fed's decision-making, 1.7%, both below the 2% that is their stated target.
Sure. Wage growth, too. We saw wage growth pick up a little bit, 2.6%. And the employment picture remains strong, unemployment at 4.1%. Kind of a weak ending to the year for jobs, added, I think, 43,000 jobs, less than expected. But the whole year. And the labor supply is tightening, so it's not
2.6% is actually obviously higher than the 1.7 and overall. So wage growth is where we've been watching for that first sign of inflation.
Right.
We'll continue to watch that. PPI rose, but it wasn't too bad.
Interesting thing to follow up on for December. There's 2 components to the consumer sentiment surveys out of both the Conference Board and the University of Michigan Sentiment. Consumer attitudes currently and those forward-looking. Currently, consumer attitudes improved again in December, but in both cases, future expectations declined. So I don't know if it's the political situation and tax reform, changes like that are kind of having consumers feeling a little uneasy, not sure what to expect in the future, but we are starting to see that reflect in their attitudes.
Yeah, the party's going great right now, but we all expect it to end at some point.
That's right.
Is what it sounds like. Some of these tax reforms could actually put a cramp on what we've seen in housing growth, we just talked about.
Yeah, you can't no longer be able to deduct your interest on your mortgage.
Right, they've put a limit on the level, but they've also given us such a standard deduction that
you likely won't itemize.
Right, 94% of all taxpayers are expected to not itemize, just take the standard deduction going forward. So, you know, things like the housing write-downs, we would expect to potentially be cramped a bit. Charitable giving, certain other things, although you still can write off some of your interest.
Sure.
We talked a bit about the Fed. We had an interest rate hike, 25 basis points or 0.25% in December, got us to 0.125 to 1.5%.
That was our third hike for the year.
Right, and we got 3 expected in 2018. There is a bit of a difference, though, right?
Right, that's what the Fed says. Now, if you actually look at what the market's pricing in, according to futures, it looks like 2 is more likely.
Yeah, I think the market's been more correct lately than the Fed.
It has.
If you think back even to 2016 when we were supposed to get 3 or 4, we got 1. Yeah, and what the market expect?
1.
More like 1, yeah. All right, and we'll get a new Fed chairman, Jerome Powell, February 3rd. We really don't expect any volatility around that particular issue. He's a known commodity, and the market knows this already, that the change was coming, so don't really expect much. This is the important part where we put on our hat and look into the crystal ball. Nick?
Things still look good broad-based in the economy, not just here domestically, but international as well. So we do think it's going to be another positive year for markets, not to the extent that we saw last year with markets up more than 22%. Probably something more in the single digits, mid-single digits, would you say?
Yeah, that's what I would expect. And part of that is just because of the current valuation in the market. We're at a PE of 23. Long-term average is about 16.5. I believe in reversions to the mean, and often we get those. You know, if we see something a bit more healthy, we could see earnings continue to grow. We had 11.58% growth in earnings in 2017.
Forecast in 2018, 25%. Now, we don't necessarily buy into that number, that growth is going to be that substantial. However, it should still be a great year. We have the reform, deregulation that should continue to drive earnings higher and make companies more profitable.
Right. It would make valuations more reasonable if we had those mid-single digit price increases with 10, 11% earnings growth. But I'm sure if we get that kind of growth, we'll probably have more in price.
Sure.
I believe that wraps it up.
Sure.
This has been your market update for January 2018 from Henssler Financial. Thank you for watching.